What's going on, guys? Welcome on into this week's live stream. We are live here going into the upcoming week after one of the worst weeks we have seen. One of the worst days and one of the worst weeks, and also one of the worst starts to the year that we have seen in the stock market's history. Some wild stuff that we saw this past week, but we're about to dive into it, kind of unpack what's going on. I want to talk about a couple of things. We're going to dive into all that stuff. We'll talk about sentiment, which you guys know I've been talking about. We'll get some more updates on this. We got the Fed meeting. We'll talk about that. And then we'll dive into a bunch of stocks and setups that we're watching. I think as we speak right now, we're seeing a lot of stocks and, just quite honestly, a lot of stuff that is holding or just breaking down below supports and falling off a cliff, as they say. So that's all that. We're going to dive into it, and let's see how the S&P is setting up to start us off, because that's what we look at. We'll look at crypto a little bit too. Honestly, holding up pretty decent. I think that's also the expectation is that a lot of people are like, hey, SPY jumps, crypto's jumping with it, and to a degree, well, not to a degree, they've been hand in hand. They have been for quite some time, but crypto's holding on. I mean, we'll look at Bitcoin in a second, but it's been holding on, whether you like that or not. Okay, here's how the S&P finished up this past week. It's just a nasty day. We had somewhat of a consolidation, somewhat of a range that we were trading in between this upper 420s down to like 415 that we were trading in earlier in the week. But we broke below that, closed at 412 on the nose across SPY. Let's look at futures really quick, because I think that's one of the biggest things we want to look at, but it's one of the biggest, I guess, I don't want to say false signals, but to a degree, this is not the best way to look at things and how to feel about going into tomorrow. Because as we speak right now, if you look at futures, we'll see that small cap futures up 0.2%, tech is slightly down, everything's slightly down, honestly flat, or pretty flat, going into tomorrow. So we'll see how this changes. I imagine this is going to change in a substantial fashion going into tomorrow, but that's what we have at least for right now across the board. Pretty flat, slight green, but that's it. Okay, back to SPY. What's going on, everyone? We'll dive into fridge. We'll talk about that one too. We can look at that. Say positive. Yeah, I mean, that's part of the game. The Fed's this week too. I want to say part of the game, but also understand that when you have these big time drawdowns and across a lot of stocks, the stock market in general, right? When these drawdowns happen, it's happened before, and the sun rises the next day at the end of the day, right? The biggest problem that people are going to have is when they have options expiring or stuff that they freak out, panic sell, or this or that, or you're buying stuff at the top, and that's the biggest problem. So hopefully throughout what we talk about and all that stuff, we at least make people visualize, or people can see hey, what am I doing? Get some of their opinions on that. Doesn't mean that, hey, no one has any clue what's going to happen tomorrow. I mean, yeah, we might gap down, and yeah, the speculation based on how we close, we might gap down on SPY. I could see that finish green or gap down and go to 397. You know what I mean? For all we know, which would be nuts, but I could see that happening. So that's the reality. The Fed is coming up this week, so that will be a big. We'll do a live. I think it's Wednesday. What is it? Today's the first. Yes, I think the Fed is Wednesday. We'll do a live for that again, and we'll see the reaction from the Fed. I guess it's a minute, and then we're also going to get Powell's press conference. The biggest thing will be the press conference. We'll get the press release and all that stuff, which will come out. I believe it's like 2:30 or 2 o'clock usually Eastern time, or maybe 3 o'clock, I forget. And I think it's 2 o'clock Eastern time. And then 30 minutes later, Powell does his little Q&A. That's going to be really, really cool, because we'll obviously get some stuff inside of the press release that they release. That'll be very, very telling of what they're thinking and what they feel. And then it's going to be key when Powell gets hammered with a bunch of questions. They're going to be interesting questions, I think, because especially with that GDP print we got last week. Let's pull that up really quick. I might as well, just at least for those who didn't GDP. That's at least for those who didn't see this. We pulled if I believe here it is. It's the start of a recession. This is where the fears are. So technically speaking, here's this article from Yahoo Finance. I don't care, advisor, this, whatever, despite big GDP miss. So GDP dropped by 1.4% annualized rate, and they expected a 1% gain. It's a pretty big miss on GDP. And the technical definition of a recession is 2 quarters in a row of negative GDP. I believe that's straight off the definition, technically speaking, if you want to get technical. So that's the reality when it comes to GDP. Here's the history chart. It's actually really cool. I haven't even seen this until just now. Here's a chart going back through history showing you pretty much, this is GDP. So we had the massive GDP dump Q2 2020, expected shutdowns, all that stuff, right? Then we had the massive gain Q3 2020, and we've been up ever since. And this is our first little wick to the downside. You got to go back to, we had a couple negative GDP prints. We had Q1 2014, but that was quickly reversed in a pretty substantial way. We also had a negative GDP print in 2011. And then we also had one late 2011 too, but those are not back to back. And then you got to go back to 2008. 2008, we saw the negative GDP. 2008, 2009, GDP was negative for a substantial time. And then so, these little gray areas are, I guess, technically recessions, I believe, is what they're pointing out. So we could potentially be looking at that technical definition coming up at the end of the next quarter, which we shall see. However, a lot of people, from what they say, they're not worried. Hey, they're not worried. We're fine. No worries. This negative number has to be explained, blah, 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 whatever. Number of signs of strength that I think are worth pointing out. That's what you're going to hear. And of course, it doesn't look good too. Let's think about this. Going into the midterms, is it going to look good if we are in a technical recession? No. You know what I mean? So they're going to probably do whatever they can do to make sure that does not happen. But doesn't mean we can't have a negative couple of GDP prints after the next, quarter or two. We shall see. That's going to be something that this thing, no one's thinking about that, but it's just, I guess, and also, is it a huge deal? I mean, it's just this big term, realistically, right? A lot of stuff is going to be, selling off beforehand, could sell off during, and could sell off after. I don't think it necessarily means that, oh my gosh, recession, sell everything, get out, and I got to go run for the hills. Like, that's not what it necessarily means. Every situation is different. So there's that, at least to think about. Rates rise 6 times. Well, if they do that, like if they do go across or they do actually raise rates the amount of times that they are now, we're seeing the past couple months projections, you 100% are going to recession. So the question is now, do they actually want to do that? And will that be beneficial long run and send the U.S. into a recession? Is that what they want to do going into the midterms? I don't know. Or would they try to avoid that or try to kind of walk this fine line? So that's the situation that they're essentially in. Fed, government, all that stuff. So we'll see. Cannabis stocks got destroyed last month. I mean, hey, with the market being this is the weekly chart on SPY. Each of these candles is 1 week. That's 4 red weeks in a row. It's pretty nasty. We have a couple of these, higher wicks followed by just sell-offs, just hammers down. So yeah, it's pretty nasty. And I would imagine, especially with some of those cannabis stocks, MSOS. Let's look at how that ETF has done. Yeah, I mean, new lows. I mean, it makes sense. The past 4 weeks, it's pretty much mirroring SPY. Not mirroring, but it's mirroring SPY in terms of red-green. It had that bounce mid to late March, and in the past 4 weeks, red is what it is. Now, if you believe in this space, this is, these are the times to be picking something up. This is something that MSOS is not something that you want to have any sort of short-term options, in my opinion. Unless you're playing for even playing for a catalyst, it's just a risky play. We've seen how those things have been, absorbed, where we had the bill and all that stuff popped in it and fell right back off. So it's risky. This is something that you want to be just accumulating for the long run. This could even be one of those types of ETFs that you just, it's one of those where you believe in long term. You've done the research on the companies, you like the companies, you're fine with holding the ETFs, you have more of a, balanced exposure, and you're just going to chill back, do what you want to do, get 100 shares, do whatever you can do to get 100 shares, 200, get multiples of 100 shares, sell covered calls to minimize your downside as it sells off or as it pops up, sell covered calls against your position, and that's it. That's the type of play that I'd be looking at. It's not something that I would have any intention really of selling anytime soon, unless we saw some sort of mass, craziness like late 2020 or like late 2020 and early 2021. We saw federal legalizations and it was just insane. We saw some sort of crazy rally for an extended period of time. Then maybe, sell. But right now, it's not the time to do so, especially if you're bullish on the sector long term. This could go to $5 in the next, who knows how long. It could go to $5 for all we know. But if you believe we're going to get a federal legalization at some point, then it's not something that you want to be selling necessarily down here, unless you're trying to trade it, or swing trade it, saying, hey, it's going to have more pressure, or whatever. So, and that's how it tends to go too. You'll start to flip and play with the trend, and then the problem is that most people flip and they start getting puts or going short a lot of the stuff that's been beaten down. They start doing it at the bottom, whereas the risk reward starts to become exceptionally against, it's not in your favor for a lot of stuff that has gotten sold off to the degree it has. The thing is, though, if you look at large caps, I'm just going to go back to SPY really quick. If you look at large caps and you look at some of their valuations, like if you go deeper into okay, let's look at, some other numbers. And when I say other numbers, I mean, if you go down to let's just look at Apple. If you look at Apple's price to earnings, if you look at some of these different metrics on Apple and other large cap stocks, you'll see that some of these valuations that these stocks are trading at are still very, very high. Obviously, they've come back the past couple of months in a good way, which is healthy, but they're still relatively high compared to a collection of, let's say, mid caps or small caps. The true carnage, and it makes sense in these sell-offs, the big dogs go last, and Apple, to be honest, is holding up a lot better than a lot of other names. Nvidia, let's look at Nvidia. It's starting to really kind of crack down. Let's look at the weekly charts are better to look at. It's really kind of cracking down a bit here, and it doesn't look good. Yeah, could this come down a lot more? Sure. But a lot of these are the names you're starting to see a lot more weakness inside of. But if you look at other stocks, I don't know, if you want to go and look at an MVIS, a stock we haven't talked about in a long time here because it's just been dead. Look at MVIS. So the stock has been dead since, you got to go back to essentially the first quarter of last year. And, we're over a year, past that. The stock has dropped from $16 at the highs we saw then. It hit up to over 28. It's down to 3. You know what I mean? These are the types of stocks. Now, this is, I think, still a pretty, I believe, overvalued in terms of some of the fundamentals, price of sales, things like that. But there's a lot of other small caps and mid caps in this range. Let's look at Tattooed Chef. I know a lot of people like to look at Tattooed Chef. It's a fairly popular social media related stock. Look at the past 4 weeks on Tattooed Chef, just obliterated. And then their price of sales is now coming in at 3. They've got some good growth outlooks. I mean, longer term, 5-10 years from now, some of these stocks are looking pretty juicy. But in the meantime, they're going to get hit. And they've been hit because the first ones to go are the small caps, mid caps, not the large caps. Those are the last to go. So we'll look at oil futures. We'll look at what do you think SPY is going to do tomorrow? Yeah, we you know what? We'll talk about the whole thought process there. Oil really quick is coming in slightly red, but it's honestly right where it's closed. Give or take, a couple cents. It's right there, 104.58. It's right around that 105. 110 is the spot. If it gets over 110, I would start to be concerned in a more substantial fashion. The highs of mid early April, we got up to what is this? 107. 107. So a fresh month going into things. We'll see if we can break that 107 or so, maybe hit 110. If we can, that's not looking good if you are, if you want inflation to come down. Another thing to note too, that while, here's sentiment, while things have gotten so overly bearish throughout the past, couple of weeks, specifically the past month, things have gotten so bearish, actually hit the 1 year bearish high. We'll see if this number comes in higher. It may, because we're going to get the new week vote or the new sentiment votes coming in by, I think, Wednesday afternoon. So by Thursday morning, we'll have the new data for the next week, and then we'll see if these numbers, how much they change. So we're going back the past month, and you're noticing that we kind of started the month off, and you had a decent amount of bulls, relatively speaking, still a lot more bears in general. Kind of got a little bit choppier. You saw less bulls, more bears the next week, and then you kind of saw those numbers kind of pushing back and forth a little bit more on the neutral side after that, and then really getting much more bearish this past week. Over a 50% on the bearish side is pretty substantial for this survey. And just the historical averages here, just something to think about. Usually we see 38% bullish, 31% neutral, and 30.5% bearish. So it's always slightly weighted to the bullish side, which makes sense given the past, 50 plus years of the market. We kind of have a general feel or a general kind of sense of where things will go, at least in the mid to longer term. But this is the next 6 months. It's what they're polling. So we'll see. That's oil. We talked about oil. We'll see how this ends up shaping up tomorrow. We could see obviously news break out by tomorrow morning that could send it up or down. That could change. There's usually been some big pulls on that. I do want to mention Fridge, FRGE. Let's pull it up on FinViz really quick, just because we may as well take a look. So it hasn't been trading. Okay, that's the weekly chart. Here's the the daily. So it's a SPAC. It's honestly looking pretty good, but here's the spot. Let's go back to Webull. Better to draw in here on Webull. Let's pull it up. FRGE, it's been kind of one of those, like, it's kind of been in the top gainer list the past couple of weeks, but here's your clear area of resistance. It's like, it's quite clear. It's right here. This thing is not breaking $20 and staying over $20. Once you break $20 and stay, that's a good sign. And right now it's holding the 50 SMA support. So you're in a range between 15 and $20. Until that range breaks, it's a better buy at 15. It's a better sell at 20. It could definitely break out, come back, test 20, and then go for more. But just make sure you're aware of this. $20 is going to be your key spot. If it gets above 20, you want to see it holding above 20. And ideally, that would be key. So on top of futures, I do want to mention really quick, we briefly touched on Bitcoin a few minutes ago, but let's just pull it up and just see how it's hanging. Here is BTC as we speak. So Bitcoin's sitting at 38.5 roughly. It is breaking down underneath this uptrend that it was kind of holding the past couple of weeks, back to past couple months. We'll get rid of this little line. It was holding that, but it's still in this consolidation. So it broke the downtrend right here, but it's still in this consolidation zone. I mean, it's got the lows of this area around 34,000, and it tried to break over 48, but it couldn't do that. So you're in this pretty wide range, and it's going to be very, very, at least in my view, you're going to be looking at the stock market, S&P, Dow, NASDAQ, more specifically, I would say more like NASDAQ, to really be a good correlation for this. And that's going to be it held up a lot better than I thought. I mean, let's just look at this chart. This is the daily chart. Each of these candles are 1 day. I mean, look at how this finished off. Obviously, yeah, it finished off last week, towards the lows or at the lows, but not that bad. Given how volatile Bitcoin is, my guess would have been that this could really start breaking down. We could be seeing this thing down in the lower 30K range, but it actually has been holding up in the upper 30s. So it's not terrible in my view, but it's been really in line with the S&P. So I'm not a huge fan. Again, longer term, I don't want them to trade together, ideally. So here's a look at futures, and that's actually interesting. So the VIX is elevated a tiny bit. Small cap slightly. Tech up 0.2. Everything's barely up. But again, we talk about, usually like, okay, 0.25, 0.25% or more is somewhat substantial. Over 0.5%, okay, it's getting there. It's pretty big. But again, we can erase all of these moves overnight. So just make sure you're aware of that. We got extremely bearish last week, and I don't think Friday did any favors. The thing about this, though, if you look back at this, look what happened last time. We had the Fed meeting, I believe. Let me go back. Let's just go look at these past couple meetings. Look at the dates. All right, let's look at the Fed meetings, and let's line up some of the biggest stuff coming up this week. Okay, so what do we got? Federal Reserve meetings, April jobs report, what to know in the markets this week. All right, so as of Friday, the Fed funds futures, let's see if I can pull this up in a second too. We'll jump to that in a bit, and we'll just check it out. Let's read this through. A 99% chance probability that the Fed will increase rates by 50 basis points, bringing the target for the federal funds between 0.75 and 1%. They've been pretty transparent on this. We're going to pretty much get a 50 basis point raise. Like we pretty much know what's happening, and like that's it. I was hearing rumors like about a week ago of a 75 basis point. I highly doubt that. Again, we went with a 25 basis point hike last time, and I would highly doubt unless, which I don't think is we were really seeing, unless inflation was like really exploding, and it was like, and we're looking at oil right now, and oil starts ripping back up, and it's at 115 again. It's just kind of sitting back. I just don't think they're going to do more than that for this meeting. Things can change by next one, but that's what we're looking at right now. Toss in the negative GDP print we were just talking about a few minutes ago. Toss in this negative GDP print. I mean, that's not good. And if you raise rates, if you continue to raise rates, let's just say that they raise rates at this 50 basis point level going forward or more, there's almost no doubt about it. There's a recession. There will be a recession, but we'll be in a literally defined by the technical definition of a recession before the end of this year, right? That means 2 consecutive quarters in a row of negative GDP officially. So that's that. So they want to get to 2% inflation. Okay, cool. The biggest thing for the market, I think, really that people are not everyone understands this, is going to be that next inflation number. So that CPI print, which is going to come out in a couple of weeks. I think it's like 2 weeks away, roughly speaking. I'll pull it up. CPI reading dates. Once we get the next CPI numbers, this is going to be really, really interesting in my view. Let's see. Where's the schedule? Here it is. Should be this. Yeah, here it is. Okay. So May 11th. So this is next Wednesday, I believe. Not this Wednesday, next Wednesday. That's going to be big. So when that CPI comes in, that's going to be what sets the stage for the next Fed hike. And if that CPI comes in and drops, which is potentially expected, I think we're expecting this March, April timeframe to be of the peak for now, unless something changes, the peak of the inflation push. If this comes in lower in terms of compared to the March numbers, that's going to be a really good sign for the market in my view. And what does it also tell us? The reason why is it says, okay, now the Fed now there's less uncertainty as to how hard the Fed's going to have to go in terms of raising rates. And if the Fed doesn't raise rates as much, that means that it might make sense for me to put my money into stocks, because now I can still get, the values here might make some sense. The 10-year treasury comes down. Like, these things all start to make some sense. Another thing with the 10-year treasury too, this popped to like 2.93. We'll see if it hits over 3 this week. But that's very, very key. You're going to see a little bit more, obviously, be pushed down pretty big. When there's some big downside pressure, this is going to be elevated a little bit, because you're seeing people kind of flock out of some stocks and into something that's more kind of, set in stone, to lock in a yield. But eventually, right, the more people that do that, these are going to come down, so that you're going to have a little bit of both going in that direction. So we'll see how that ends up shaping up, but that's something I'll be watching this week. This has been the kind of threshold. Over 3, you can go over 3. There's no problem with going over 3 if you just go look back in time. You have to go back over, let's say, you got to go back 2010 for this thing to be, honestly pre-2008 for this thing to be kind of substantially over 3%. But if you go back over the past decade, really, every time it's gotten to 3, it's come back in a big way, and I expect the same thing to happen this time. At least in the short term. I don't really know about the next year. Who knows? A lot can change, but at least in the short term, I expect something significant in terms of resistance here. So, that's that. It's a lot to dive into. What do you think SPY is into tomorrow? So here's what was my thought process, and I'd really honestly, if I have no idea, but I will say this. We closed so weak. We closed down 3.7% on SPY. Usually, I would say with a dirty close like that, we got some fear. We could be looking at a gap down. And I think that that's very, very possible tomorrow, meaning we open up lower than where we close. So we close at 412, meaning we open tomorrow morning. The S&P opens up below 412. And generally speaking, probably like 410 or lower really would be like a substantial gap down. Anything like 411 is like not a big gap down. It's like it's a dollar. Who cares across a $400 stock? It's not a big deal. Which is an ETF of the S&P 500, by the way. So it's not like it's an individual stock. But that said, I could see that because of how weak things closed, and we closed towards the low of the day. It made sense. But because of how weak that really was, my gut tells me that, to be honest, I just, and we were on the stream, you guys could have seen, I didn't buy puts. Obviously you can hedge. I just didn't like the put play into close. If we got a bounce into the close, which we really didn't get, here's the 5-minute chart. We never got. Into the close on SPY, what we got was a flush. The last 15 minutes of trading on Friday, we flushed. That's what happened. We just flushed down. And so if we popped up to 415, 418, dare I say, like something like that, that makes the risk reward a bit better. We're only down like 2.5% on the day. Okay. But because we finished the day down 3.7, that's a big, big red day. Looking at these charts, my gut says that we could easily bounce. And the key will be this 430. The key is going to be this week 430. Once we get back over 430, it will seem like we'll start seeing, maybe some stuff bouncing off the bottoms. Now, the problem is that may not come when you think. That may come after Powell speaks. That may come Wednesday. Who knows when that comes? Could be Thursday. Could we never? Could we just flush below and dip down here? Yeah. I think just from a psychological level, I think 400 will be a very, very interesting spot. If we did test that 400 level, would be a very interesting spot. But in my view, I'm really not concerned. If we do dip down to this level down here in the 400s, if there's no additional news that we have not gotten already, yeah, sure. Could we fall down and hold below? Sure. But my anticipation is that these next couple of days are going to be extremely volatile, swings up and down. So could we dump and people freaking out and go to 400? Could we dump just below 400? Yes. But could I also see a situation where we hit 400 on SPY or we hit below 400 on SPY? Let's say it's Tuesday. I don't know. Or maybe it's tomorrow. Let's say it's tomorrow. Come Wednesday afternoon, it wouldn't surprise me if we're at 425. Like those types of, or even bigger, even over 430 for all we know. Like these types of moves are what you have to expect when you get down to points like this, and when you get to a point in time where you have such negative sentiment. People don't want to touch anything. People are hitting, stop losses getting hit, panic sells, market sells, all that's getting hit, big time. And it's almost the same thing at the top. The top is almost the same exact way, or it has a lot of similarities, because you'll see a lot of times you get some, like even look at individual stocks, some crazy spikes and crazy volatility at the top. People are like, oh my gosh, FOMO. And then it spikes up and then it's down lower than where it was the day before within like an hour or two. Like, you see individual stocks. Mullen's a good example of that. It's just a recent, I guess, penny stock that popped up. Mullen, by the way, is kind of trying to curl off this 125 area. But Mullen did that here on, let's see, what is this day? This is the 21st of March. Yeah, Mullen had this day where it closed the day prior at 290. It hits 418 the next day, but then it ended up closing that day at 320. And then within a couple of days, it's down here back under 250. So like that volatility is what you need to expect when you start getting volume as much as we've been seeing, when you start getting this craziness. So you kind of have to let things play out. And that's exactly why, if you look at the volume too, look at how the volume is elevated. A lot of that's because you're seeing, stuff falling off, and you're seeing stuff, just breaking supports, panic sells, market sells. You only lose money when you sell. Now, the thing about them only losing when you sell, it's very true, but it's also a very bad way to start getting into things if you are trading stuff that is volatile. If you're going to invest, completely different game. If you are investing in companies that you think are going to be around in 5-10 years and that are growing, like that's how I just simplify it down that level. Do you think Tesla's going to be around in 5 to 10 years? Like as an example, whether you think Tesla's overvalued, undervalued right now, who cares? Do you think it's going to be around in 5, 10 years? Do you think they're going to have more cars than the road? Do you think they're going to have a bigger company? Do you think they're going to be selling more cars? Do you think they're going to be growing? If you think all of those things based on what you know right now, and as simple as it is, just looking at the future of where the world's going, right? This is not a stock that like you should be panicking over the thing dipping 10% in a day, like which it did do back on like Monday or whatever it was. Not a stock to panic over that. Who cares? These are the types of stocks, like, again, maybe this is a bad example because it is up a lot, right? But maybe there's a stock, I don't know, maybe I haven't looked into Tattooed Chef like too much, but I know a lot of people who like Tattooed Chef and who believe in this thing longer term and the plant-based and all that. And I see that stuff in the stores these days, especially you go to Whole Foods, like it's a lot of it's everyone's going plant-based. It's like where a lot of people are going. Now you got a decent amount of people who are still saying like carnivore and all that stuff on social media these days. I'm not sure if you guys have seen a bunch of that stuff on, TikTok and whatever like these days. But that said, this has been big. Like there's a pretty big shift in going that way. Now, if you believe in Tattoo Chef, it's a stock where here's a perfect example. Like this is a stock that if you are seeing the growth and you believe it'll be here in 5, and you believe it's going to be bigger in 5-10 years, they're going to be selling more products, they're going to have more on the shelves, all that, they're going to get into more stores. This is not something to be selling at the literal bottom when no one's buying it. This is the time to buy, just dollar cost average in and forget about it. Because yeah, you might be down on this investment 50%, depending upon maybe it's down even more, but it's a different situation. If you're in a trade and you very well know this company is not something you want to hold for 5 to 10 years. It's not something that you want to be around or you want to be sticking around overstaying your welcome. That's this type of stuff where you get into trouble when it comes to, only lose when if you're looking at Dogecoin, like again, like this is a perfect example. Like if Dogecoin, if your thought process is I only lose when I sell, you know what I mean? The reality behind Dogecoin is this thing going to be around? It probably will, but will this thing be, you really see the value in Dogecoin versus a lot of other coins in, 5-10 years? with regulation, and who knows? Like, do you really think that this is going to be valuable? So that's the thing. You have to just make sure you're thinking of when it comes down to thinking, I only lose when I sell. It's good and bad. And if you're coming from an investing side, it's not the same as coming from a trading side. They're different. Even if your trades are, swings and whatever, it's just different. As long as you're aware of that and understand, you're good to go. But these times of panic though, are the best times. We've seen the biggest rebounds. These are the best times to buy. Again, realistically. Now, you have to have your faith in that. Again, I don't want to, go too deep into like the politics side of things, but you got to think about this too. Is it going to look good come midterms when you have the current administration dealing with a legitimate recession? Like with the definition of, like, again, for those who are not aware, let's just literally pull it up. We pulled it up on Friday. The definition of a recession right here. A period of temporary economic decline, which trade and industrial activity are reduced, generally identified as the fall in GDP for 2 successive quarters. Okay? So GDP down 2 quarters in a row, recession. We got the first one. GDP was down last quarter. Do you think that that's going to be something that's going to look good? I don't know. But will they try to fight that? Will that be a thing? I don't know. But it's not going to look good. So if that doesn't look good and the stock market's tanking and everyone has no money, not everyone has no money, but you know what I mean, get the point. Stock market's tanking, recession, you're going into midterms, you can bet you're going to get a red sweep across a lot of stuff. You almost guarantee it. You know what I mean? And then they know it's coming. They know it's going to happen. So there could be some wonky stuff, especially going into the midterm votes. We'll see, but I wouldn't be surprised for some wonky stuff. Just something to think about. Anything could happen. And if it happens, it is what it is. It's not one indication. Oh, well, that means I better buy, and then they're not gonna let things tank. No, things can tank. The Fed's job too is not to deal with the stock market being down. They don't care. Like they do, they don't. That's not their goal. They're not in charge of let's make sure the stock market is propped up all the time. No. All right. Long the Cannabis ETF. I think it's in the long term, it's something to just stash away in a portfolio, maybe dollar cost average in. Don't have to worry too much about it. Let it do its thing. Cannabis ETF. What are your thoughts about PDF or pattern day traders making unlimited trades? Do you think depositing is worth it? No. Yes. What I would do is a cash account. And that's as simple as that. If you have under $25,000, use a cash account. Okay, so start, and I would recommend doing that beforehand. If you have $25K to deposit, don't just toss it in and start day trading like crazy, because if you fall below, you're stuck, and then you can't day trade. And then it's like, well, now what do I do? So I guess got to swing, or I got to become a long term investor. No, just use a cash account. TD Ameritrade, Webull. I don't know if you can do that on Robinhood. I don't know if you can. I have never tried. Whatever, Interactive Brokers, E-Trade, whatever brokerage platform, TradeZero, whatever platform you want to use. Cash account, and especially on Webull, I know they have next day option settlement. So if I have a $10,000 account, a cash account on Webull, which is this platform right here, link in the pinned comment. And also, if you're interested, whatever, there's free stocks galore. Every platform is giving out free stocks these days. If you want to get them, great. If you don't. And people had a comment recently about a Webull video from a long time ago. I switched from TD Ameritrade to Webull because the reason why was because of the pre-market access. On Webull, you have pre-market access from 4 a.m. That was from 4 a.m. all the way to open, all that stuff. There's not many platforms out there that will give you 4 a.m. access unless you're over certain thresholds or whatever. Just that's why I switched. Plus a couple other things, just fundamental layout. I liked it better and whatever. It's up to your personal preference. I don't care what platform you use. It doesn't matter what you use. If it works for you, it works for you, right? But if you're going to if you're going to swing trade penny stocks, and nowadays Robinhood just extended their hours. But if you were going to swing trade penny stocks in the past, and you're using a platform that only allows you to trade from, let's say, 9 a.m. to 5 p.m. or whatever, let's just say normal hours, from 9:30 Eastern to 4 p.m. Eastern, normal hours, and a penny stock that you're in spikes up on positive FDA news at 7 a.m. and you can't get out, you can't take profits, that's a problem, right? So just make sure you know what you're getting into in terms of that. But Webull cash account, next day option settlement, so you can trade options. Let's say I want to trade SPY options today on a cash account. That money, let's say I had a $10,000 account, I use $1,000. That money would usually take like 2 days to settle if it was like a stock trade or for most accounts. But if you're trading options on Webull, it'll settle the next day. So if I use $1,000 today, obviously I can't turn around and now all of a sudden, use 10,000 from an next trade. If I have a $10,000 cash account, I will now only have, and I use $1,000 for a trade, I only have $9,000 of available cash for that day, that remaining day. But come tomorrow, whatever I use today for option trades that I then sell before the end of the day, right? I take a day trade on them. Whatever I use for that will be freed up tomorrow. And there's no PDT rule. All you have to worry about is only using settled cash. You can only just use settled cash on a cash account. You can be at 1,000, you can be at 5, you can be $100 and trade super cheap options, and you could day trade them all you want as long as you're only using settled cash. So that's what I would say for the PDT rule. These days, it honestly doesn't matter. Or if you want to use a margin account, sure. What are the benefits of doing that in these days? To be honest, there's not much unless you're actually using margin. That's it. Yeah, I guess you can take a lot more trades, I guess, if you wanted intraday, if you're really good at things. But to be honest, usually you just need a fewer day trading, a couple solid trades, sometimes just one trade, sometimes no trades in a day, and you're fine. And then that's it, so you don't need to be trading a million times. Scalps, I guess, could be, but there's not this day and age, there's not too many more benefits of that margin account, especially if you're under PDT. In terms of that stage, most people are going to benefit from having the cash account anyway. And then there's not many restrictions as it is. You can also get multiple brokerage accounts. So let's say you wanted to go ahead and day trade on a margin account and utilize margin, whatever you want to do, or just whatever. You can open a Robinhood, you can a Webull, TD Ameritrade, E-Trade. Each account you have will give you 3 day trades per 5 trading days. So technically speaking, if you had 10 accounts, you would then have 30 day trades per 5 days. You just need to make sure if you take a trade here, okay, get in, get out. Okay, boom. You exhaust 3 on this account, go to the next account. And you have to you keep switching accounts, which would be really annoying. And then you wouldn't be able to get used to the platform as much. But, it could be something, it could be, people do that. So it's something to think about. All right, a couple red days until Fed meeting. One last up for Fed rates Wednesday. Awesome. What was the last meeting the Fed had? I forgot to pull that up. Last Fed meeting, this is the CPI. I wanted to pull, here's this. Target rate probabilities for May 4th Fed meeting. They're expecting essentially there to be about a 50 basis point raise. To get you the target rate would be 75 to 100 basis points because right now it's at 50, it's at 25 to 50. So that's what that's coming in. The June would be, so let's see. Yeah, it's going to be interesting to see how this plays out. But the June, they're projecting us to be in the 150 to 175, which would mean that if we had right now, what are we at right now? Right now on the Fed rates, the federal funds rate, we're at 25 to 50. So this would suspect that we're going to see by this May 4th date, that they're going to raise 50 basis points. Okay. Pretty much guaranteed. I mean, unless they do something wild, the market will react. If it's less or if it's more, there will be a big reaction. If it's more, expect a dump, much bigger dump. If it's less, I would expect a rip. If it's in line, it could rip or it could dump. Who knows? Last time, I believe the market ripped after the Fed rate hike. June, so if you go back to May, right, they're going between a 0.75 to 100 basis point level. By June, the expectation is 150 to 175, which would technically mean that that's a 75 basis point hike come June, is what that's pricing in, if the math is correct, right? That's what that's saying, and potentially even more. So this seems a little elevated in my view. I don't know. Let's see what July is looking like. By July, they're forecasting us to be just shy of the target rate by July, like 2.5 roughly. So, okay, so we'll see how this ends up shaping out. It's kind of a cool slide to look at. Okay, cool. So that's that. But what happened? What was the last Fed? Let's see. FOMC meeting May. Okay. Stocks, this is an interesting little article. Stocks may see a massive rally following the Fed meeting. Why? Because they've sold off in anticipation and they've acted like a de-risking event since late 2021, and that's what we've been noticing. Any rally isn't likely to be long-lasting as the macro force will be too much to overcome. Okay, cool, whatever. Yeah, so that's May 4th. That's when we're getting that information. I want to go back. What was the March meeting? I want to go back to March. I wanted to go back to March to get the date on the March meeting. So the Fed March meeting was the 15th and 16th. Okay. Let's see. They released the statement on the 16th. Yes. So what happened back in March? It's just something just to look at the past meeting. They on the 16th of March we were ripping. So yeah, this is it. So the bottom was put in technically a couple of days prior to the Fed meeting last time. They then raised rates on the 16th, and then the market from there dips a little bit and then ends up finishing up here at 434, and then goes on about a 2-week rally to 462. So that's what we had last time. Just something to think about. And in terms of if we see the same type of thing play out again, if we do rally around that meeting, let's say we dip tomorrow, something like that, and then bounce and rally, then of course the key spots are going to be, obviously do we make a higher high relatively speaking this year, or what? So 450 would be a very key spot. Let's draw a line there. So let's just start drawing some levels. This is the S&P. So 450 will be key. That was a hard reject last time. And then of course beyond that 450, we have the double top here at 457. So 457 next, and then beyond that, this 462. So a fake out could be still, that's still far away, right? If we did bounce and push up into these areas, who knows? You could break above, but you got to get some continuation above for it to really be a solidifying move. We broke above this 457, and then we dump right back below within 2 days, which was not a good look on SPY. So those are our key spots. I'm not super concerned, to be honest. I guess there are some spots to watch. Let's draw this 430 in here. There's that 430. And I'd say, a rough area would be like right around in here, 437-ish is a spot that was support, then was our, clear sentiment shift. Also lines up at the 50 SMA, so 437 will be crucial if we test up there in the next couple of weeks. I don't know, but that'll be a key spot to watch on that. Not to mention, guys, look at this. It's kind of crazy. So we got the death cross, right? As funny as it is, and people don't like this, and they do like it, whatever. But it's a lagging indicator. It's when the 50-period moving average crosses below the 200. So it's a shorter time frame moving average crosses below a longer, showing you that momentum essentially right now in the shorter term is down versus bigger picture, it was more up. The 50 SMA crossed below this, okay? And then that happened essentially at the bottom. By the time it crossed at the bottom, we saw a rally for about 2.5 weeks and then right back down. So that 50 SMA started to kind of curl up a little bit, and it looked like we were maybe going back for that golden cross, but no, definitely not. So we're going to need, if this thing wants to come back and actually cross back over the 200, which again, it'll be a lagging indicator if it does, because in order for us to do that, for the 50 to cross the 200, we're going to need some significant strides back to the upside, right? For that to happen. But if it happens, then you're going to start hearing golden cross this, golden cross that. It's the best time to buy. The problem is going to be, the S&P may very well be up around like this force up towards all-time highs for all we know, if we're going to get that move, or if that indicator, depending on how long it takes, those indicators cross back. So I don't know, not to say that that's going to be an added factor, but it could be an added factor. People saying, until we get the golden cross, I'm not going to go long. We start getting momentum back to the upside. Golden cross happens whenever it happens, and people start buying in. The problem is that you're going to be buying in, again, back towards the tops of the past couple of months, or 6 months, however long it takes. I don't know. You're going to be buying in back towards the tops, where maybe you had a much better opportunity down here, or down, wherever we end up in the next couple of weeks. Just, for me, I like thinking about things. I'm not a momentum guy. Cool, we can identify momentum, cool, but I'm not one to be FOMOing into momentum. That's not me. So you're going to see me buying generally down here rather than up here. All right. Let's see. Sorry, I'm jumping back through some stuff. All right. Feds have to be careful. No, and that's exactly it. Again, with like we said before, with the negative GDP print, they're gonna have to be careful. So I'm really curious. This is stupid stuff that I never thought I would be doing. Really, honestly, a couple years ago, who cares? Who would care about this stuff? And most people don't. But I kind of guess you kind of geek out into that stuff a little bit. But the wording of how they word this press release versus the past press release is going to be very, very crucial. So when we get the official statement from the Fed on Wednesday, I believe, when we get that and we're able to compare it to the last one, it's only a couple paragraphs, a couple pages, whatever. It's pretty. They can pretty much concise it down to minutes, I think. When we get the next minutes, whenever right, comparing to the last one, we very, very crucial to show you where their heads are at and say, okay, they're seeing this, they're this, and it will tell you if they're more in favor for more hikes or less, and it will give you a better hint to the future. So that's going to be really cool. But they got to be careful. Again, I think we understand that they got to be careful, because if you with the negative GDP print, here it is. With the GDP dropping, you're at risk of this year going into recession. This year, not even talking about next year, which I think it's a lot of this year. Now, the yield curve inversion. Let's see. Let's pull this one up too. Yield curve inversion. This is, I believe, that the data will tell you that. Let's see. Zoom in a little bit. Warning signals suggesting. This is one of the biggest indicators for a recession. The problem is that it happens, generally speaking. Look at this recession. Look at this. It's funny. On Google, look how many people are searching up recession. This is where I also think you're in a weird spot, because a lot of this type of stuff doesn't work out this easy. If it does, well, then you know what? I'm wrong, right? Maybe the thought process is wrong. But it never works out this easy, where we assume, okay, recession is coming, means sell stocks, just like we're seeing the market do right now. The market's pricing this stuff in. The market's doing all this stuff ahead of time. It's not like, the recession finally hits and the market tanks. Yeah, could the headlines drop things a little bit? Sure. But the reality is that a lot of that work is done prior to that. The freak out is done prior to that. So it's something to think about. Let's see. Outside of that, priced in. They're pricing they're pricing in substantial hikes though going forward. After this meeting, we pretty much know a 50 basis point hike is coming. After that, the hike the projections are pretty high, and so with the negative GDP print, you're running the risk of the recession word, and then you're going to have issues if inflation backs off. So that's the other key. It'll be the CPI print. So you got the Fed this week, then the next week is CPI. So you just pack it all up. We got some data coming out almost every Wednesday. It's going to be a big Wednesday, it seems like. What's going on? Wait on the sideline, follow the market, start the trend. Could take. No, yeah, it definitely could. Here's my thought too on that though. And of course, if you're just going to trade it, then it's fine. But the problem is, if again, for a bigger picture, long-term investing, whatever, right? That's what we're talking about now. Okay, if you waited for the bottom, this is not against anyone who does that, because I completely understand. Wait for the bottom to come in, wait for the bottom to be formed, wait for us to start trending up. If you did that, what did that get you last time? Well, what happened last time was we started to trend up. Fed meeting comes in, we start ripping. When do you buy back in? You could have bought SPY, but let's say you're buying SPY. Okay, you're buying the S&P 500 ETF, and that's it. You want to just get into the S&P, and you wanted to try to time it. Well, you could have bought it sub 420 a couple of days. You got that opportunity. But it starts to kind of bounce, and now it's back over 425, 430. When is the time to buy in, right? When is it time to buy in? If you waited for it to break back over the 440 high from right here, from early March on that little bounce, great. That happens. You buy back in at 440 or something like that. You move 20 points up, and then now, boom, we get rejected and we faked out. Do you stop yourself out for break even? You could, right? And I don't know if that's worth your time, worth your while. Or are you still in and now you're stuck because you're holding the bag, you're holding it back down. So that's the only problem with trying to time that. Because I think we were all on the same page of well, this looks pretty strong. We're reversing out of this come late March. And that's exactly what we saw. And that was the fake out. We broke over these highs seemingly too fast. We're talking about all-time, we're within, a few points of all-time highs. We're talking all-time highs here, back on the 29th. And then here we are a couple weeks later, about a month later, and now we're back at 412. Or we're back below the lows of, well, I guess below the March lows, February lows, 409. Same thing. We're back to the lows. So it's not as easy. Again, it's easier said than done. In a perfect world, things play out slowly. The bottom comes in, and then it takes us 6 to 12 months to come back and test all-time highs again. And, you buy in and nice and easy, and there's not as much volatility, and it was a pretty straightforward, reversal play. But it doesn't work like that all the time. So, long time ago, it felt like that was kind of the situation, but it seems like, especially right now, we're in a pretty volatile time. Things can be, we can move on SPY. 20 points in a day is nothing. Like we can do that easily. I mean, it's a lot, but that could happen. We've seen those moves past couple months for sure. All right. I am currently, what am I? I'm 23. I'm going to be 24 in a couple months. But yeah, 23. And technically, too, the people don't realize this. Technically speaking, and it's not something that I necessarily care too much about. I don't flaunt it because I don't really care. I technically do have a finance-related degree. I went to school originally for meteorology, then I got a minor in energy business finance. So EBF, as they say. Do you need to have that type of stuff or that understanding to pick things up? Not necessarily, in my view. You could be all self-taught. You can learn everything yourself. Be really, really good macro. Be really, really good day trade. Be really, really good swing. Be whatever sector, whatever you want to crypto. Doesn't matter. You can teach yourself. But a lot of people don't know that too. Graduated in the depths of the pandemic. 2020 was the year. So I'm at the point now, realistically, which is kind of nuts. I have to think when people ask how old am I, it takes me a second to think about. Used to never really care or never really think about it. Or I guess I would always just know. Now I'm like, how old am I again? 20 something? Yeah. But yeah, I'm 23. I probably look like I'm a lot younger too. So I imagine I'm probably going to be carded at bars for the next 10 years. It's a good thing, I guess. Diesel fuel stocks, NGRU or NRGU. Let's look at that. The only problem is going to be, it's not doing bad. The only problem is going to be what happens if we get a tank on oil. This, it's a little sketch to me. It's building higher. Again, it's trying to build higher lows again after the past little pullback. But this little crackdown scares me here. So my guess, if I was looking at this, to be honest with you, I'm looking at this and I'm saying to myself, this is a short opportunity for me. If I had to pick, and where would I be risking? Well, we got some range on this stock, so it's a 3x ETF. Okay, so we got some range. The risk, in my view, is the high. So the risk is going to be 510 roughly, and my reward is looking like I want to see this thing come down below this 316, so below $300. So yeah, it's not a bad short trade. It's not higher. The higher the better on the entry. That's what I'm looking at. When you get a crackdown move like that, sometimes it can fake you out and sometimes we can kind of bounce back up. But these are the types of moves where you get a big pullback like that. Now, as they start to come back up, that's where you want to start positioning for that trend reversal, ideally. If it doesn't work, it doesn't work. But I'm not a big fan of that, especially with where oil's at. It could, if oil starts pushing up, yep. I'm just not in the camp that oil is going to be back over, 115, 120 again. And if it does, then that'll be a play, right? But I'm just not in that camp. Could be totally wrong. Again, who knows? But with the whole Russia situation, like that could all unravel even further, and we can have a situation where that starts spiking even higher, and I wouldn't be surprised. But it's a little bit of a dangerous slope. So not a huge fan of this, especially being up this much. If you're just buying shares, you could have got this thing honestly sub $100. Many times over the past year and a half to hold this. The problem is your risk reward right now, in my view, is not as good as I would want it. So that's just how I see it. Doesn't mean it's a bad play. It's building higher lows. So until it breaks below these lows, it could be a valid play to the upside, which is I wouldn't want to see it fall below 317. Realistically, I would want to see this thing hold 350. So that was this wick right here from on Wednesday. I want to see 350 hold. If 350 cracks, I would be like, okay, I could step out. No need to kind of get stuck in this thing. You can buy with unsettled cash. You can't sell. Yes, for those, I'm not talking with a cash account. Technically speaking, you can buy again with unsettled cash. You just have to wait to sell. You have to wait to be able to sell till that cash that you then bought with settles. If you catch how that works. So if you on Webull, if let's say I have a $10,000 account, I take a day trade for $10,000, I can now buy a stock for $10,000. I just can't sell it that same day, or else I'll get a good faith violation. I'll have to wait until that cash settles for me to be able to sell it. That's how that works. On TD Ameritrade, is there a cash sweep op? Is there a cash sweep option? There's a rule. How would I know if I'm using margin? I'm not sure. I have not been using TD Ameritrade as of late. I use it I have an IRA account with them. I don't know for sure. I have an IRA that I just have deposited some money in, and I have one stock in there, and that's really it that I hold in there. I don't think you can do spreads without margin on Webull. I don't know if you have to have margin. You might I think you need to have just a different options level. Unless if you do need margin, then that's that. But I don't think you can. There are restrictions to that on that. But if you're talking about just buying and selling calls puts, you should have you can do that on a cash account. But yes, you might need a margin account if you want to take it a step further to do spreads, which then of course it complicates things. But that's where it might make more sense in that situation if you're going to be doing spreads to then have multiple different accounts to do spreads that are margin accounts, so you can do it across multiple different accounts, like a Robin, a Webull, TD Ameritrade, E-Trade, whatever. Something like that. Again, it depends on what you need. If you're just doing spreads, then yes, then it might make more sense if that's how these brokers restrict you. Then yes. Might be missing the stream. No, you're all good. No good. See rallying bound. I think again, we'll see how this contrarian thought goes, and it's not something that's like to get too caught up in, all the time, but. When you're at very, very interesting peaks, when you're at very, very, crazy times of greed, it's a good indicator, I believe. And when you're at crazy times of fear, it's a good indicator. Those are the two times. When you're in limbo, it's not great. Like when we were in this limbo on SPY, when SPY was back around 445, 450 a couple days ago, I don't know. It's the best. We're kind of bouncing back up. You get people starting to feel a bit better about things. Some people are still fearful, and it's like, you're in between. But when you're at these big, these big points, the downside, upside, and you're getting a lot of people going greed, going risk on. That's a good too. Now, the thing about this, though, too, is that generally speaking, these situations tend to last just long enough to burn the majority of investors or traders, right? That's how it works. Same thing on the top. Same exact thing with the crazy pandemic market that we saw. No small caps, no stocks under $1 on the big boards. Nuts. But it made no sense. And it was making no sense for a long time, right? For the people who've been around for a while. It made no sense for a long time. But what happened was when stuff started to kind of pull back, people were like, no, we're going to keep going higher. And so you have most people at the top who start getting bullish, and then we end up seeing the backside. Same exact things that happen on the downside. But it takes a little bit longer. So if you're going short into some of that stuff, most likely you probably got stuck. You probably got stopped out. You probably got burned. AMC, GameStop were crazy examples. But there's a lot of other stocks that were, the exact opposite situation. And we looked at MVIS about like an hour ago now. MVIS is a perfect example. I'll go to the weekly chart. MVIS probably stopped people out last spring when it hit $28. Probably stopped you out, freaking out, like, oh man, this is going to keep going. I got to get out, even though it's so overvalued. Makes no sense. What happened was it stood up there just long enough to burn enough people, and then boom, they missed they could have missed this massive backside. And these things this might not be the best example, but there'll be situations like this where maybe it's ARK. I don't know. There's a lot of stocks in ARK that I'm not a huge fan of anyway, but I don't think that they're necessarily going to be super, super prohibiting of a move back up. It could definitely go back up, and I can see ARK back at like, $80, in a quick hurry, if we see a rally in the market. But that said, just like ARK, this thing is going to get hit. No one wants to be in ARK. And then you're going to step back. And if you start shorting ARK now, your risk reward is horrible. Let's just be honest. It makes no sense in my view. It makes no sense at all. If you're going to short it for day trade swings, sure, and you think we're going to see more pressure in the markets, great. If you think SPY is going to fall off the next couple of days, that the Fed's this, and this is going to cause the market to pull back a bit, well, ARK probably pulls back, double or twice as hard as like, SPY sometimes or the Dow. So if you look at this past sell-off, it's been, massive relative to the S&P or relative to the S&P, the Dow, and the NASDAQ. So it's not a bad short necessarily if you think the market's going to go down. But big picture, if you're going short shares right now thinking the ARK's going to go to 10, could go to 10. We probably would need to see a much ARK 1 to 10. We would probably be experiencing the worst. I don't know. Would it be the worst? One of the worst. We're up there as it is, this year so far for the start, just numbers wise. But we'd be up there rivaling some of the biggest and the worst drawdowns in the history of the market. If that happens, if for ARK to go to like 10, it's still a big, from that's saying the thing is now how much it is. That's telling you that ARK needs to drop from here. It would need to fall another 80% from here after already falling from the highs about 70%, but people will start getting short now. Could be the ones that get stuck on the wrong side as it bounces back up. Now, maybe this thing bounces back up to, $80 and then sells off big time and, whatever. Maybe. And maybe it ends up being, dead for a long time. But the reality is that most people start doing that at those key points, at those crazy, crazy fearful times. And people start getting long at those crazy, crazy greedy times, those crazy, crazy bullish times. Everyone's bullish. Everyone's saying, no. Right now, go gauge social media. Go gauge comments on this stock and that stock or whatever. What is everyone saying? Everyone's saying crash, sell, panic, fear. Like those are the words that are going around, right? Epic, all that stuff. But what was the exact phrasing? Now, this could prolong, right? It doesn't have to just reverse tomorrow because of people saying that. No, it doesn't matter. But what matters is that the big picture is that a year and a half ago, what we were seeing to the moon, diamond hand, like none of that stuff is being said nearly as much as it was being said. I mean, let's just go look. I mean, you can go look at Google Trends, baby. Let's take a look at Google Trends. I think it's just interesting to look at. What do we got? Let's just look at like some crazy terms. Diamond hands. Like, what is diamond hands? Like look at diamond hands over the past 5 years. No one was talking. I mean, I guess, you had the pandemic crash, right? So that kind of got you going. But diamond hands was an AMC thing, essentially. That's when it spiked. Look at it now. No one's talking. No one's saying diamond hands. You know what I mean? To the moon. I guess maybe there's a little more of this. To the moon. Yeah, I guess a little bit more. Past 5 years to the moon is not just a stock term though, I guess. So maybe it's I'm a little off for that. But it spiked up here. What was this? Early, about a year ago, it spiked. Now it's, relatively speaking, it's whatever. But like just terminology like that. Let's see, like stock market crash. No one's talking stock market crash when the market's at highs. People are talking stock market crash here back. What was this? This is March 2020. Yeah, it was the March crash. You had this term being really tossed around back in 2017, 2018. We saw a pretty decent pullback in the markets. Around 2018, 2019 timeframe, early 2019. Market crash was tossed around when the market was really, really dumping a couple weeks back, a couple months back. Past 12 months, what do we got? Yeah, market crash has been more talked about, as of late. We had this January pullback, had the late Feb pullback, and now we're seeing it pop again as we're kind of pulling back into the end of April, early March. So it's just kind of interesting to see how that stuff gets tossed around and all that good stuff. It's just always, in my view, it's always interesting. All right, I got to catch up on a lot of comments. All right. Job report is bad with declining GDP. Fed wouldn't have the balls to raise. No, you know what? That's the thing. And it's an interesting thing because you think about, the jobs report's bad, economy not doing as good. In a weird way, it's technically potentially seen as a good thing for stocks. So, realistically. I have so much calls for tomorrow. I'm so nervous. The problem being with that's the biggest problem with that is that if you have expirations very, very short term, I may have a bunch and I'm taking a pretty substantial risk by doing so, but I have made sure that I have decent amount of time on my positions to let things play out. But young Powell always managed to pump. Yes and no. Yes and no. We'll see how that plays out. I think that the 25 for real, Powell. It would be nuts if that did. I don't know if it happens this meeting though. I think we would there's maybe the potential talks of a 25 basis point hike this meeting if last month was we showed inflation coming off the peak. It has not done that yet, so I don't think we're going to see that until maybe next potential hike. Let's see. Intraday has been nuts. Intraday has been good. So, if you're worried about the longer term stuff or the bigger picture, then hey, no problem. Take a step back. It's fine. Intraday is providing a lot of up volatility too. If that's what you want to do, then that's what you want to do. Everyone get my puts tomorrow. Go short. The whole market rips the rest of the week, even with the 50 hike. I think that's a very, very reasonable scenario. Here, I'll go back to SPY. Here's SPY's day. Let's go to the daily chart. I think it's a reasonable scenario. I think it would be crazy. It would be fun to see. Maybe it would be very scary to see for a lot of us, I guess. But if you're looking at your portfolio value, if you really care about the day to day, day traders do. But I don't think you should do that if you're an investor. You should not be caring about the day to day value of your portfolio. It's not. That's the recipe to be stopping out, chopping up, and all that stuff. But if we do come down 400, even I think we just test just below, go to 397. 397 on SPY would be a panic. Would be utter panic. If we get that, and there's no reasoning and there's no additional news as to why, like there's no oh, Russia did this or this happened or that. I think that's going to be a springboard spot, at least for the short term. Who knows what happens in 6 months, at least in the short term. All right. Lots of stocks have moved up fast and furious too quick. Well, that's what you're seeing the backside right now. Let's see. I'm all in on gold stocks. One call on SPY. What is GLD looking at right now? GLD. Yeah, honestly, it came back down. It's held so far at this 175, so it's holding up on one. I think GLD. Yeah, this had a nice little move a couple weeks ago, back in early April, with and see how it kind of lagged. It's just behind the market. Like it kind of actually moved up very similar. Just a couple weeks after SPY moved up, and then it pulled up. Now it's trying to hold 175. It's not a good correlation, but not a perfect correlation, I should say. To SPY by any means. So it's not the best. Obviously, it's not supposed to. But let's see. Recovering will bounce. Let's take a look at futures really quick and just see what they're setting up, because we have been going for like an hour plus. So futures as we speak are slightly green, but not really. Barely green. So my guess is my recommendation would be don't even worry about this stuff. Go to sleep, don't worry about it. Even if you have calls expiring tomorrow or puts expiring tomorrow, who cares? We could open up tomorrow up 0.5%, sell it all off, and go down 3 on the day. Or we can open up down 1%, down 3, and finish the day up. You know what I mean? That's the market we have. Bausch & Lomb IPO. I haven't looked into that. I don't know much about them. I might have to see. But I think it could be an interesting time for an IPO, because no one wants to, if it's a potential longer term idea, this is not a very, very hot time for IPOs, I'd imagine. There's been some, but I don't know how much attention that one would get. My guess is that you might not be having to pay an extreme amount of money for it. Like some other of these IPOs that get priced in or open up, 100x or not 100x, 10x or 100% up off of where they, where those insiders or whatever, or wherever those pre-IPO investors, I guess, got in. All in on gold. I do like the gold plays. I do like there's a bunch of them I do like. I've got a list of them we can dive into, but I really think in small cap land, essentially, I really want to see my thought on the overall small caps. I'm not going to try to, you could, there's a couple individuals that I like more fundamentally that I'll hold. There's only 2 of them right now. You could hold them up, down the whole way, up, whatever you want to do on that stuff. If you're, looking for the undervalued plays. Yeah. The problem with that for me is I just see that right now, other than select names that have a ton of cash and I feel confident on, or you may feel confident on, you're just going to wait. There will be so many opportunities when the market reverses back, because when we look at SPY, when SPY was back at 462, right? And it was like, wait a second, we're actually bouncing back up. And SPY was up here, there were still so many small caps hitting new 52-week lows. So there's going to be a million to choose from, essentially. And that's why I love small caps. But until the market tells us it's time, I'm not interested in holding a bunch of them. I just let them play out, and then you're going to miss some. You're going to miss some, right? But there will be 10, 20, 100 more where that came from that will offer a great risk reward once, if, and when, because it will come back when we start seeing more volume in small cap land. These things have been selling off for the past year. Eventually that's going to turn. Maybe it's next year. Maybe it's not anytime soon, right? I don't know. But when that time comes and we start seeing a lot more continuation follow through, that's where those bottomed out plays offer a much better risk reward and offer a better timed entry, so to speak. Like Grill. We look at Grill. I saw it. Here it is. Grill. We looked at this thing. I mean, fundamentally, this is actually a decent small cap. I mean, based on where it's trading right now, all that stuff. Like, they're growing, they're expanding, they got more cash than their market cap. But there's no eyes on Grill. If the market heats back up, maybe Grill goes from 40 cents to 46 cents, and SPY goes from 415 to 460. Grill could still go from 46 cents to $1, or let's say to 75 cents, on a spike, on a pop. There's a lot of meat on the bone on some of these names that you'll have. There's no need to rush into them, the way I see it. Bullish on semis. Yeah, I like the semis. I obviously have calls on this guy on the 3X ETF SOXL, but that's out to November now, so there are plenty of time out on those. I haven't traded 4X, so I'm not the best to answer, but on the platform side. But Pfizer has earnings on May 3rd. Be careful. Gonna miss. It wouldn't be a bad idea. Didn't Pfizer pull back in the after hours? I think they pulled back in the after hours a little bit. Yeah, they pulled back a little bit in the after hours on Friday. They dumped a little bit, so I'm not sure what was going on there. We wanted to look into that. But yeah, I could see them coming down to maybe 45-ish, 46. Opinion on Mara? I don't know. I do. I mean, realistically, it's Bitcoin. So as long as the market, let's look at Mara. It just broke below this support. So yeah, it's not trading, one-to-one with Bitcoin exactly. It just broke below some key spots. You have to be more, it's less technical and much more fundamental, at least in this side of things. If you think the market's going to bounce and Bitcoin bounces, it'll do fine. If the market doesn't bounce and Bitcoin doesn't bounce, this is not going to go anywhere. I do think that there could be a lot of upside on this as a possible swing, but you got to have, I would say, a stop point in mind, and just maybe it's more of a fundamental stop, or it's like, hey, Bitcoin falls under 35K, I'm out. Something like that. I don't know. Could be a better idea. Every IPO would spike green first day. No, yeah, that was a nutty time. GLDI, SLVO, gold and silver ETNs that pay monthly dividends. Those are nice. Goro took a beating. Yes. I know Goro was one that I had been playing a while back, or at least I was in, or at least I have it on my list. I know that somewhere. Ooh, Goro, let me tell you, this was looking pretty good a couple weeks ago, but it was coming up into that area. Look at this. Came up into prior support, acting as resistance. Boom, back on down. Very similar to Load. Let's see, LODE. Where's Load? Load is at, Load just dipped just below support. Honestly, Load down towards $1, I would say, is a good spot. Those are two that I like. Load's not a pure gold silver play. I believe it's not pure anymore. It's more of like an EV battery type play these days, but they are a mining play. AMD earnings. I don't even want to jump into, again, I don't even want to take a guess on these earnings. We have no idea. Just like we saw with Apple. Apple kills it, sells off. Amazon doesn't kill it. It's a crapshoot, at the end of the day on this type of stuff, which I'm not really super interested to try to guess. There are certain plays that could make sense. I'm actually going to jump over to, what would Ford do? Ford had earnings the other day. Yeah, it didn't really do anything. Really, honestly, it didn't really do much. 390 dip, and then it's sold off a little bit. But what's going on, Kyle? I'm going to wrap things up, unfortunately, for those jumping in now. But we can go back and watch. We've been going for about an hour and 15 minutes, which is nice. But I'm going to wrap things up here in a second, looking at futures. Tech up a little over 0.25%. Everything else, barely up. Is it a big deal? No. We could be, you could wake up tomorrow morning with everything massively red, for all we know. So I'm not going to try to guess that game. But that said, we talked about a lot of stuff here. Sentiment, we talked about the Fed. There's a lot of things to think about, again, with the Fed. And, we talked about going into midterm elections. You already have talks of the student loan situation. And I think we had, what do you have last week? Mitt Romney saying it was a bribe to young voters, whatever it was. But you're going to get that. That's going to be it. This, whether you like it or not, it's part of the game. It's part of the game. Do you think that they want to go into midterms with a recession on our hands? It's not going to look good, right? So I don't know. You're going to have a lot of ups and you're going to have a lot of sketchy stuff happening, I think, in the next couple of months. Crazy stuff. It's going to be fun. It's going to be, as much as it is painful, maybe for portfolios and stuff, it's really an exciting and interesting time. Because either we're about to see, a really crazy bounce that no one really sees coming, or we're going to continue to have one of the worst years ever, or one of. Obviously, there have been worse times, I guess, with some of these massive drawdowns. But this, if it is a prolonged bleed, it will be. We're on pace potentially to have one of the worst years in the S&P in a long, long time. So it's going to be crazy. It's going to be cool. I mean, it's a, you're witnessing, obviously we're seeing history, right, being made, obviously, which is cool. So it should be a lot of fun to see how the next 6 months, honestly, the next 2 months play out. And then of course go by there. The way I see it is this: it's day by day, it's week by week, it's month by month. Going past month by month, in my opinion, it's a crapshoot. It's not, you gauge rough ideas, but past that, as to what you think is going to happen, it's not even worth your time to try to, it's just stress over. So with that said, I'm going to wrap things up. I appreciate you guys like always. Fun is a strong way. It definitely is. But that said, thanks so much for tuning in. Thumbs up button, links below, support channel, all that good stuff. There's a lot of good resources down there too, videos, playlists. I would recommend that stuff for people who are new too. Options videos, Webull videos, explaining a lot of stuff. That's the biggest thing. Thanks so much, guys. Appreciate you. We'll see what happens tomorrow. We'll go live tomorrow for Power Hour. We'll do live Monday, Wednesday, Friday. Wednesday, we'll probably do a longer one for the Fed. We'll do the Powell whole thing. I'll hopefully have him streaming live. We'll get to watch an interview live, all that stuff like we did last time. So that should be cool. Talking about how the market reacts to that and all that stuff. Thanks so much. And I'll see you guys in the next one. Have a great rest of your weekend and have an awesome week.